Hi to all. In this video, we will cover the iron condor, which is quite an interesting strategy in which we have limited upside and we also have limited downside. And an interesting feature we will see in this case is that we will form this strategy both as a net short position as well as a long position. So we will have a short iron condor, which is the one we may usually see when we are looking for information on this strategy. But we will also form a net long position, a long iron condor, and we will understand the differences between the two. So in order to form the short iron condor, which is the one you will usually see, once again, when you're looking for this, searching for this strategy, we need two things. The first is a bull spread, and that bull spread, we will form that bull spread with put options. And then a bear spread, and we will form that bear spread with call options. So let's keep in mind in this case, right, we will have a bull spread and we will have a bear spread. We can think about a butterfly spread, but let's keep in mind in the butterfly spread we have only call options, and then there's one distinction, which is we use three call options and there are only three strike prices. Then the bull spread, we form it with x1 and x2 with the call option with the lowest strike x1, and then uh, using a short writing a call option with the higher strike x2, and then the bear spread we are forming it with a long position or buying, right? The high strike call option, which is then X3, and then we are selling or writing the call option with the lower strike, which is X2, right? So we would only need X1, X2, and X3 if we are forming a butterfly spread. We would need X1 and X2 for the bull spread, and then we will need x2 and x3 for the bear spread, right? Now, when we are forming an iron condor, now instead of having three different call options, we're having four call options. So we will form the bull spread with x1 and x2, and we will form the bear spread with x3 and x4. So, in my perspective, the main distinction between these two strategies is that we are letting x2 and x3. So we are letting this high strike call from the bull spread and low strike call from the bear spread. We're letting those to be different. So we're no longer having two options of the same, and now we're having two different options. Of course, we also have the distinction that we are forming here bull spread with put options, and then we're forming the bear spread with call options. This is important, right? We have been learning that a bull spread we should always form it with call options, and that a bear spread we should always form it with put options, right? Bear, we're bearish, we form it with puts. Bull spread, we're bullish, we form it with call options. It's quite intuitive, and that when we have done it like that in the past, we avoid the possibility of early exercise risk. So in this case, we are precisely choosing to form a bull spread with put options. So we have that early exercise risk, and we have a bear spread with call options. So we have that early exercise risk. But of course, once we put these two things together, then, well, our concerns are resolved in the sense that now we are exposed to a completely different set of risks, which are the risks that are inherent to the iron condor, and no longer the risks that are relevant for a bull spread or a bear spread independently, right? So let's begin with the bull spread with put options. So once again, we want to form an iron condor. I want to keep this short, but let me just go over these details. Bull spread with put options, and that's the first thing we need for an iron condor. And then the second leg of our portfolio will be a bear spread with call options. So we're basically familiar with how to do this profit diagram, but we're going to work on it together so we can see how the chart comes up. One important thing, if you're looking for actual data, uh, you need four strikes, right? And we need them in we need x1, then x2 should be greater than x1, then x1, x3 should be greater than x2, x4, and so on, right? And let's keep in mind, for example, the lower strikes x1 and x2 correspond to the put options, and then x3 and x4, those correspond to the call options. When we look at the premiums, right, just before we start filling up those cells, when we look at the premiums, then if we see these are put options, so for put options, the lower the strike, the lower the premium. The higher the strike, the higher the premium. For call options, the lower the strike, the higher the premium, right? Because it's easier to get in the money. And the higher the strike, the lower the premium. The lower the strike, the higher the premium. The higher the strike, the lower the premium. Okay, so it's now that we have all this information, if you're working on this for your project, or if you are working on using real data, you can go to Yahoo Finance, look for the options chain, and then you can look for the actual values, the true values for all of these things. Now, I'm saying that this is a short iron condor, or you're forming this iron condor where you basically have a net short position. Why is it that I am saying that? Let's go over this here. So in this iron condor, we have these two legs, right? Let's look at the bull spread first. So if we have the bull spread, now you're forming the bull spread, that leg of a portfolio. If we're forming the bull spread, then we're buying the low strike and we're selling the high strike. And we're buying the low strike. We're using put options for the bull spread. So we're buying the low strike, and this should be negative, right? We're buying at the premium. So we are buying the low strike put because we are forming a bull spread with puts. And then we are going to sell the high strike put, which is this one, right? So our outflow is $3, our inflow is $9. When I press enter, then this is basically the net cash flow that which is the result from forming the bull spread with put options. Now the second leg of this iron condor is the bear spread with call options. So a bear spread, we buy the high strike, we sell the low strike, and we're forming it with call options. So we're going to buy equal negative, we're buying, it's an outflow, we need to pay for it. And we're going to buy, now it's a bear spread with call options, so we're going to buy the high strike, which is X4, and the premium is 2. And then we're going to sell the low strike, which is X3, and the premium is 8. So once again, we have a $6 net cash flow. And now, if we keep in mind that each option contract controls 100 shares, then we can multiply this by 100, and we can multiply this by 100. So long story short, let me move this here so it matches, or let me fix this here. So long story short, as soon as we do that, we can calculate the overall cash flow, net cash flow, and it is a positive cash flow of $1,200. By the way, in this, that's why we're saying that this is a short iron condor, because we end up with a net short position. That means our short positions, the positions we are writing, those are the ones we are selling. So we're selling those premiums are higher than the positions we are buying, where we have to pay money. So because what we are selling has a higher price than what we are buying, we end up selling more than what we are buying. So we end up with more value in the written options compared to the purchased long options. So we end up with a net short position. And by the way, this is also going to be the highest or the maximum profit that we can get from this iron condor if we are just forming it the way we are usually seeing it online, which is the short iron condor, which is equivalent to basically like selling an iron condor, right? Or at least it's a net short position. So now if we want to fill up this chart, let's do it quickly. We can do it in the following way. So we have a bull spread with put options. That means we will have two put options. We will buy the low strike. That we already said that, and we're going to sell the high strike. So we're going to calculate the first, just like we have done in previous exercises. Let's calculate the intrinsic values first, right? Which is max of strike one, and then we just lock this one minus the price of the stock because it was blocked. So, but I selected the cell A10, right? And then it's the max of the strike minus that stock price or zero. So these are random prices, by the way. These are the prices we believe the stock may be at when we reach the end of the horizon, reach the maturity, the expiration of uh, these options, and we close the portfolio. So because I locked the strike price, right, I can scroll this downward. Let's first calculate the intrinsic value of the second put option. So in the second put option, it would be strike 2, and then we lock this minus this strike price, comma 0. And there we go. And let's keep in mind, bull spread, we're forming it with put options. So I'm using the information here, which is the information that corresponds to put options, right? Now we have these two intrinsic values. We can move this down. And as we move it down, we will see that this is the usual. Put options have value um, when the stock is at a low price. The moment the stock is moving up, is moving up, is moving up, it moves above the strike, then the put options no longer have an intrinsic value, or the intrinsic value is zero. Now let's calculate the profit. So let's think about this intuitively, right? If we're forming a bull spread with put options, once again, we first buy the low strike X1 put option, which has a premium of $3. Because we bought this low strike put option, now we are entitled, and this is some sort of a story, I'm saying this intuitively. So we are entitled to the intrinsic value of this put option. Okay, and next we are selling, so positive, we're selling the high strike put option, which has a premium of $9. And because we're selling, in other words, we are writing this put option now, we are liable, or we lose the intrinsic value of this put option. We can think about it in that way, right? If the investor exercises, then we would have to sell. Uh, we would have to buy from the investor at a higher price than the price of the market, right? And there we go. So now these are the profits that we have from this bull spread constructed with put options. If I scroll this, before I scroll it down, we need to lock the prices. So we need to lock the cells G6 and we need to lock the cell I6 where we have the premiums, and then we can scroll this down. And there we go. So we see that we have these losses and then we have a maximum gain, and then of course we multiply this by 100. So we have the losses and gains of a contract. We see, by the way, that the losses are greater than the maximum gains, but that's okay. That's a bull spread with put options. So now let's quickly form the bear spread with call options. Once again, we just get the intrinsic value of the call option 1, call option 2. So with call option 1, this is a low strike call option. And by the way, I should rename this just to be consistent. Actually, this should be C3 and C4, right? Let me rename it here as well, just so that this number makes reference to the corresponding strike price, right? It's more, it's better and clearer in this way. So a maximum value, we're looking at the intrinsic value. We all know it's the stock price minus the strike price, because this is C3, call option with strike 3. Strike we know is this. And then we lock the strike, comma 0. Now C4, it's max of the stock price minus the strike price, which is X4, comma 0. And of course, we have to lock this strike price here. Once we do this, we can scroll down, and now we have the two all possible intrinsic values for C3 and C4. Now, what about the profits? Well, if we are building here a bear spread with call options, let's keep in mind in a bear spread, we're buying high strike and we're selling low strike. So we buy the high strike call, which by the way is the one with the lowest premium, right? And then let's lock this. And because we bought this high strike call, we are entitled, right, to the high strike intrinsic value. And next, we are going to sell the low strike call option, which is X3 and has this premium. We lock the value of this premium, and because we wrote this option, we sold this option. Now we are liable for the intrinsic value of this option here. So we just scroll this down. As soon as we scroll this down, we acknowledge that there are profits when the stock price is low, and then we have loss, constant loss when the stock price is high. So that is a characteristic of a bear spread, right? We are making money when the stock price is low. Then we multiply this by 100, and so we can get the actual value here. Then finally, iron condor is just a combination of these two things. So we just add them up. And let's keep in mind, for a while, we are going to get 3,800 as loss. Then there is a range in the middle where we get some profits, and then we go back to that 3,800, which is again a loss. Now, I had already, in the interest of time, set up this chart, which basically you just click insert, you select all the values, you select the line chart, and you will get the same thing. Um, and actually, once you create this chart, if you want to change the numbers here in the x-axis, you can right click, select data, then we edit these labels here, so we can actually select the values of all possible stock values here. Okay, okay, and now it's a little bit better because we can actually see what this means, right? This is an iron condor, and it's a net short strategy, a net short portfolio here. And if prices are very low, like here, we have this loss, which is 3,800. If prices are very high, we have that loss. And there is this range of values, and at which we actually get this profit. And by the way, this profit is 1,200, right? And then there could be some values here in between. So uh, basically, the maximum gain from an iron condor, you're getting it when the stock price is right there between the middle strike prices, right? So there we go. We are pretty much set. And then in the next video, I will stop this video here, and in the next video I'll just repeat the same, but we will go over an iron condor when we take a long position, or in other words, we're buying the iron condor, and we will see how the shape of the iron condor is different. The important thing that distinguishes the important the distinction between the short iron condor or a net short position on this iron condor and a long position, net long position from an iron condor, is precisely that in one, which is this one. We start with the 1200. So that is important. When you form the iron condor, you get the 1200. So this is a very important thing. So you end up with $1,200 in your pockets. Now, if the price of a stock remains there or remains within this range of values that give you the maximum profits for this iron condor, you just keep that money that you collected when you formed the iron condor. Now, if price goes up and it crosses the strikes, the middle strikes, and then the second strike, then you will then incur losses, and you already know that the maximum loss is 3,800, right? So, but the main thing here is that when you form this, you're getting these $1,200, and though that will remain in your pockets. And then if you were right, price stays in that range, you keep the money. If you're wrong, price went down, price went up, then you lose, and you may lose as much as 3,800. But we know this beforehand. Thank you for your attention. In the next video, we cover the long iron condor. I hope this was helpful.